For more on this, we're joined by Kent Moores, editor of Energy Advantage. Welcome to the show from Pittsburgh Live. Let me start with this on the energy situation in China. Since 1993, a lot has changed. China's lost energy independence. But has the strategy worked out so far, and what exactly is that strategy now?
Well, hi, Phil. The strategy is threefold, essentially. There is still a move to attempt domestic production. The fields in China are aging. The unconventional potential, however, in tight oil as well as in shale gas would appear to be expanding, and there is emphasis in this, and we're going to see that intensify in the future. There has been a massive move abroad to control upstream assets. And when Chinese companies do this, generally successfully, what they're actually doing is allowing Chinese imports to be more determined by transfer pricing within state corporations than normal market pricing. Finally, we do have a massive increase in imports, as the story just mentioned. But with many parts of the world in general, and Iran, for example, in particular, the Chinese are able to pay for this essentially because of their trade surpluses. So those rising imports are not automatically having the same fiscal and monetary difficulties in China that they might have elsewhere.
Well, I mean, I suppose, hence the benefit of having a surplus in your economy, specifically a trade surplus, because you don't have a trade deficit. You have a lot more money in this particular case. Now, China, the world's biggest oil importer now, that's been making headlines for a while. How big of a deal is that in terms of global demand?
Well, global demand is rising in any event. And so as more and more of the exports are now focused upon Asia, there was, for example, a report recently out last week by the Asian Development Bank that projected a massive increase in expected imports into Asia and the Pacific region by 2035, centered, of course, in China. With all of this going on, the export potential and expectations are moving in many parts of the world toward China. Now, what impact that's going to have in terms of price remains to be seen, but we have to recognize the fact that global demand in general is rising. If you forget about Western Europe or North America, the established industrialized nations, elsewhere in the world, the demand is beginning to intensify.
Okay, so the demand is certainly there. We know that China is the biggest car market in the world already. They obviously need gas to power those cars. It's natural to think that prices have to go up. So here's my question. Forget about demand for one moment. Do we have enough supply over the next 20, 30 years to supply China as they buy more and more cars, or India, including the U.S. and around the world? What's the sustainability issue here?
That's a very good question, and essentially that question is not easily answered at this point. We still have 4 major reports over the last year, each one of which suggesting at current demand projections, including, of course, the spike in Asia, by 2015 to 2016, we may begin to see some regional spikes and some regional shortages worldwide. The supply tends to be out there, but the lead time of moving the supply in, especially unconventional oil, may not be sufficient.
We started this segment talking about the potential, I should say, potential breakup of these big oil companies in China. You're an expert on this. Share with us why this is such potentially a game changer, or is it?
Well, I think it basically is. Competition is the name of the game in any market, but especially in energy. With more players, you have a number of advantages that are moving in. One, of course, is attending to the pricing problem. But the other situation essentially is, as you have smaller players, there are more fields and more assets that can be developed below the horizon of profitability that was normally the case with larger companies. You break them up into smaller companies, they focus successfully on specific basins and specific fields, you tend to get more production at less overall unit cost, and that's essentially an advantage to a market as a whole.
Kent Moores, this story continues to play out. Thank you very much. Live for us from Pittsburgh.